Hello there future ACCAs, I welcome you all to this session. I'm a proud Fintrama, Vishnu Vijay, and your lecturer for the Advanced Audit and Assurance paper. So folks, in this session, we will be learning about how an auditor deals with fraud and error. And of course, we will also look at a topic known as professional liability for auditors as well. However, before we deep dive into these topics, let's take a quick revision as to what we've looked at in the previous session, shall we? So, we are at part B of the syllabus, that is professional and ethical considerations. And of course, in the previous session, we first of all learned about the ACCA's Code of Ethics and Conduct, isn't it? Where we looked at the 5 fundamental principles of ethics. And we also learned about a memory aid to remember those 5 fundamental principles, isn't it? What were the 5 fundamental principles again? We just have to remember COPET, isn't it? C stands for confidentiality, O is for objectivity, P is for professional competence and due care, I is for integrity, and the next I is for professional behavior. And then after that, we learned about the ethical threats. And we yet again learned about another mnemonic there as well, isn't it? What exactly was the memory aid? SAFE, isn't it? So what does SAFE stands for? The first S stands for self-interest threat, and then we have the self-review threat. A stands for advocacy threat, I is for intimidation threat, and the final F stands for familiarity threat as well. Okay folks, so we have quite a bit of memory aids to learn a lot of concepts, isn't it? So remember all those are really relevant for your exam. And then we looked at the safeguards as well. Okay folks, so whenever an ethical threat arises, we have to keep some safeguards in place to prevent such an ethical threat from happening, isn't it? So that's basically it. Okay folks, so we learned about safeguards at both the audit firm level, the professional body level, as well as the individual level as well. And after that, we looked at some example situations where an ethical threat can arise, and of course the safeguards that we can keep in that situation as well, isn't it? So remember these situations, those are really important. Why? Because in your AAA exam, the examiner will provide you with a scenario, and they will require you to identify the ethical as well as professional issues from the scenario, explain them, and where possible provide a safeguard as well. Okay folks, so remember that. That's a really important question in the exam. Okay folks, so remember these concepts and the example situation that we looked at in order to tackle those questions in a bit more easy manner. Okay folks, so in the previous session, we primarily focused on the ethical issues, isn't it? And now in this session, we will be focusing more on the professional issues. Now, when we talk about professional issues, there are many things, and of course we will discuss the professional issues for more than 1 or 2 sessions as well, so keep this in mind. However, in this session, our primary professional issues that we will talk about is basically the professional liability for auditors. Okay folks, we will look into that. That's like one of the core topics that we will be discussing today. And another core topic would be the ISA 240 fraud and error as well. Okay folks, so keep this in mind. And of course, other than that, we will also discuss some small topics known as professional skepticism, which is basically the attitude that we need to have throughout the audit process, as well as another small topic known as expectation gap as well. Now, I know that some of you might be a bit familiar with these topics from attending the Audit and Assurance paper, and for those who may have got an exemption from this paper, you may have learned about these concepts from your graduation or any other professional courses. However, what you have to understand here is that ACCA has a peculiar method of testing these topics in the exam. And our objective here is to learn that particular technique and prepare a strategy of our own so that we can tackle those questions easily and score easy marks in the exam, isn't it? So that is exactly why we will be covering these topics from the basic, from the scratch, so that you can get a better understanding as to how these questions would be asked in the exam. And of course, you will also learn as to how to apply this knowledge in the exam questions when we practice questions in the question marathon as well. Okay folks, so remember this. So we will be looking at the first topic, first of all, that is professional skepticism, shall we? So let's take a look at as to what this is all about. So what is professional skepticism all about? Professional skepticism basically involves three basic things. Okay, folks. So first of all, it involves having a questioning mindset. Having a questioning mindset. And secondly, it involves being alert to conditions that can indicate a possible misstatement due to fraud or error. Okay, folks. So that's basically the second aspect to professional skepticism. It's about being alert to those conditions which can indicate a misstatement caused due to a fraud or error activity. And thirdly, it can also involve conducting a critical assessment of audit evidence as well. Okay, folks. So when you gather the audit evidence, you conduct a critical assessment on it. That's basically another aspect of professional skepticism. Okay, folks. So this is basically as to what professional skepticism is all about. Having a questioning mindset, being alert to conditions that can indicate a possible misstatement caused due to fraud or error, as well as having a conducting a critical assessment over the audit evidence that has been gathered. Okay, folks. So these are the three basic things. Now, let me tell you as to what professional skepticism is not about. Okay, folks. So professional skepticism is not being rude to the management or staff. Now, this is a common misunderstanding that a lot of audit professionals have. Okay, folks. So having a professional skepticism kind of attitude does not mean that you have to, be rude to the management as well as staff if you haven't necessarily received any appropriate documents on time or something like that. Okay, folks, so remember that. So it's not about, enforcing authority onto the management or staff. It's rather having a mindset that suggests this. Okay, folks, so the mindset goes like this. You believe in the management, however, it is your responsibility to make sure as to whether they are right or wrong, isn't it? So that's basically the mindset that you should have. You should not act in any hostile manner towards the management or staff. So this is not as to what professional skepticism is all about. Okay, folks, so keep this in mind. Now, moving on to the definition. So what is professional skepticism? It is an attitude that includes a questioning mind, being alert to conditions which may indicate possible misstatement due to fraud or error, and a critical assessment of the audit evidence as well. As simple as that. Three things, isn't it? Now, then there is another term known as professional judgment. So what exactly is professional judgment and how is it different from professional skepticism? Let's talk about that, shall we? Because even though these are two different terms, some students, what they do is they believe that both of these are the single thing. Okay, folks, it's not necessarily true because both terminologies have a different meaning to it. Okay, folks, so we already learned as to what professional skepticism is. Now let's take a look at as to what professional judgment is all about, shall we? Professional judgment is the application of relevant training, knowledge and experience in making informed decisions about the courses of action that are appropriate in circumstances to the audit engagement. So what's the idea here, guys? It's basically all about taking an informed decision when the situation arises, isn't it? So that's basically it. Okay, that's basically as to what professional judgment is. Taking informed decisions by applying the level of training provided by the audit firm or by the knowledge that the individual has gathered, as well as from their experience as well. Okay, folks, that's basically as to what professional judgment is, and it's entirely different to professional skepticism. Okay, folks. And another factor about professional skepticism is that you have to maintain that particular attitude throughout the course of audit, isn't it? So keep this in mind as well. Okay, folks. So that's another really important point to understand. Now, another aspect is that how exactly will the audit strategy be impacted anyway? Because having or maintaining professional skepticism throughout the audit processes can have an impact on the audit strategy. So what exactly would that be? Would that impact be? Let's take a look at that, shall we? First of all, the auditors may not choose to rely on written representations provided by management. Okay, folks, that's basically the first thing, isn't it? Because we know that written representations are basically documents, written documents provided by the management acknowledging that what they have done is accurate, complete, etc. Isn't it? That's basically it. So, can that be said to be sufficient and appropriate evidence? No, not really, isn't it? Because it's not reliable, isn't it? So, that's basically the thing. Okay, folks? So, by maintaining professional skepticism, we may not be able to rely on the written representations. And secondly, the materiality level may be reduced. Now, why exactly is that happening? When do we reduce the materiality level? When there is an increased risk in the client, isn't it? So, by maintaining professional skepticism, we may identify certain misstatements. Okay, folks? And if we identify more misstatement after the planning stage of the audit, after conducting a lot of procedures in the audit client, if we identify a lot of misstatements, then the risk will be increased as well, isn't it? And if the risk is increased, then the materiality will be decreased, isn't it? So this is basically the relationship here. Okay, folks, if there are more errors or misstatements identified throughout the course of audit, then the risk level will also increase. And if the risk increases, the materiality level will reduce as well, isn't it? So keep this in mind. That's a really important aspect. Okay, folks. So this is exactly why the materiality will be reduced as a result of maintaining professional skepticism throughout the audit and an impact that professional skepticism has on the audit strategy. Okay, folks. And another aspect to it is basically this. Evidence provided by the audit client will not be relied upon anymore, isn't it? So we cannot necessarily trust every evidence that is provided by the client itself. So what we do is we gather third-party evidences, isn't it? For example, if there is an issue with the receivable balance, will we just plainly believe the management as to what their explanation is? No, not really, isn't it? So what we would do is we would conduct, let's say, confirmation letters. Okay, folks, so we may send out confirmation letters to an external third party, which is basically the customer in the case of a receivable balance, and ask them as to whether what the amount of the balance is and will they be able to pay us back. Is that particular customer an irrecoverable debt or not, isn't it? So all these things will be identified through that procedure, and this confirmation letter is an external evidence rather than an internal evidence provided by the management, isn't it? So which evidence would be more reliable, internal or external? Definitely the evidence is provided from external sources, isn't it? So that's basically the concept here. Okay, folks? So we do not rely on the evidences provided by the audit client, rather we rely on external evidences more if we have identified a lot of issues by being alert to conditions. Okay, folks, so remember that. And then the auditors will have to generate more third-party evidence. As I stated earlier, they may send out a lot of confirmation letters to the customers, to the third parties such as the lawyers of the organization, banks, suppliers, etc. Okay, folks, so remember that. And after that, more focus will be provided on the area on which fraud is suspected, isn't it? So that's basically another I would say advantage of maintaining professional skepticism, isn't it? What exactly is the situation here? Because when you maintain professional skepticism, you would be able to identify the risky areas within the audit. Now, if you were able to identify those risky areas, then what you can do is you can devote more time into the risky areas and conduct more procedures on them. And of course, reduce the time allocated to the immaterial or irrelevant areas, isn't it? So that's basically the idea here. Okay, folks. So maintaining professional skepticism can have the following impact on the audit strategy. Okay, folks. So remember that. So fairly an easy set of things, isn't it? As simple as that. Now moving on to a bit more relevant topic, that is ISA 240, fraud and error. So what exactly is fraud and error all about, and what is the responsibility that the auditor as well as the management have in relation to fraud and error? Let's take a look at that, shall we? So first of all, let's learn as to what fraud and error actually is, shall we? So what is fraud anyway? Fraud is an intentional act involving the use of deception to obtain unjust or illegal advantage. Now what does this mean? Well, kind of an easy thing, okay, folks. So it is an intentional act. That's the first thing that you have to keep in mind. Okay, folks, it is an intentional act, which basically means that it is not an accident. It is an intentional activity conducted by a person. Okay, folks, so remember that. And of course, it involves the use of deception. What does the use of deception mean here? the person who has conducted the fraudulent activity will hide their identity, isn't it? Okay, folks, so that's basically the idea behind use of deception. Okay, folks, the person who has conducted the fraud will hide their identity. And of course, why exactly do they conduct a fraudulent activity? Well, that's kind of obvious, isn't it? It's basically to obtain a unfair or illegal advantage for that particular person. Okay, folks, that's basically the idea here. So, well, that's basically as to what fraud is: an intentional act with the use of deception to obtain unjust or illegal advantage, as simple as that. And when we talk about fraudulent activities, there are basically two types of fraud. Okay, folks, there is the misappropriation of assets, as well as there is fraudulent financial reporting as well. Okay, folks, these are the two types of fraud that can occur within an organization. Now, what is misappropriation of asset and what is fraudulent financial reporting? Let's talk about that, shall we? Misappropriation of asset is basically stealing the assets of the firm. Okay, folks, as the name suggests, it's just misappropriating or stealing or manipulating the assets of the organization. For example, let's say that a warehouse staff has stolen one of the inventories belonging to the organization. That can be said to be a misappropriation of assets. Or it could be, stealing cash from the petty cash can. Okay, folks, it could be that. Okay, folks, those are like small scale misappropriation of assets. A bit large scale would be this. Okay, folks, let's say that a director has entered a bogus employee within the organization's payroll records. Now, what would happen then? Then the cash, which is an asset of the firm, will be paid to this bogus employee unnecessarily, isn't it? So that can be said to be a misappropriation of assets. Okay, folks, so if the director has inputted their own bank account number into this bogus employee's payroll record, then the director would receive a unnecessary payment of salary, isn't it? So that's basically, that can be said to be a large scale misappropriation of assets. There are even more larger scale scams as well. However, that's basically as to what a misappropriation of asset is all about. Okay, because it's just misappropriating the assets of the organization. Directors have a fiduciary duty of safeguarding the assets of the organization, isn't it? So if they steal the assets, then we call it misappropriation of assets. That's basically the thing. Moving on to fraudulent financial reporting. When it comes to fraudulent financial reporting, well, let's talk about an example here. Okay, folks, let's say IAS 38. Okay, folks, in IAS 38, we know that research costs should be expensed in the P&L, and of course, development costs should only be recognized as an asset if it meets the criteria stated by the standard, isn't it? However, consider the situation. Okay, folks, let's say that an organization has recorded the development expenditure as an asset without meeting the criteria of IAS 38. Then we call that fraudulent financial reporting. Why? Because effectively the item should have been an expense, and an expense has been converted into an asset without the appropriate compliance with the standard, isn't it? Now, in such a situation, what is the issue there? The issue is that the profits would be overstated since the expense is understated, and the assets would be overstated as a result as well, isn't it? So that's basically the issue behind fraudulent financial reporting. So that's just one of the many examples of fraudulent financial reporting, and another example can be stated as window dressing, which is basically beautifying the financial statement by overstating the assets as well as profits and understating expenses and liabilities, isn't it? So that's basically the thing. Okay, folks, so keep this in mind. Now, moving on to the error aspect, shall we? So that's all for the fraudulent activities. We have learned as to what fraud is and the different types of fraudulent activities. Now let's take a look at as to what errors are, shall we? An error is an unintentional misstatement in financial statement, including the omission of an amount or a disclosure. So that's basically as to what an error is, isn't it? So remember that. And of course, errors are not an intentional act, isn't it? It can be just an accident. Okay, folks, that's basically it. However, it not only involves a mistake made regarding the amounts or financial figures, but also it can also be stated as an omission of a disclosure. Okay, folks, so there was a relevant activity, relevant aspect that should have been disclosed. However, the management missed out on it. Now that can be said to be an error. Okay, folks, so keep this in mind. Then you have irregularity, which is another specific term. So what exactly does an irregularity mean? Well, this is basically an intentional misstatement to mislead the users of financial statement. Okay, folks, that's yet again a really relevant aspect, isn't it? So keep this in mind. So what does it mean exactly? So let's say that as auditors, we identified a material misstatement within the financial statement and we have reported this particular material misstatement to the relevant management. Okay, folks. However, if the management has not made any adjustments to rectify this error, then we can call it as a irregularity. Why? Because we have notified the particular management, however, they have not made any rectification, isn't it? This could indicate that the management may just be trying to mislead the users, isn't it? So that's basically as to why we call it an irregularity. Okay, folks, so keep this in mind. So as I stated earlier, if a material error is identified but not corrected, it can become an irregularity. So keep this in mind. So that's basically as to what all these three terms are, isn't it? So we learned about as to what fraud is, what error is, as well as to what irregularity means as well. Now let's take a look at the management's responsibilities in relation to the prevention and detection of fraud and error, shall we? So let's take a look. The prevention and detection of fraud is the responsibility of management, and responsibilities of management includes the following. Okay, folks, so whose primary responsibility is it to prevent and detect fraud? Is it the auditors? No, not really. Okay, folks, it is the primary responsibility of the management, to prevent and detect fraud and error activities. So remember that. And of course, what exactly are the management's responsibilities then? Let's talk about that, shall we? The management's responsibility is to first of all introduce a culture of honesty and ethical behavior. That's the first thing. Secondly, it involves implementation of internal controls to take as precautions against fraud and error. Why do we have internal control systems within an organization? To prevent, detect and correct certain misstatements that can happen within the financial statement as well as certain activities within the organization, isn't it? So that's basically it. Okay, folks, the primary responsibility for implementing such internal controls lies with the management. Okay, folks, so keep this in mind. And then we have another aspect, that is the responsibility for monitoring and implementing the internal controls lies with the internal audit function as well. Of course, it's not mandatory to have an internal audit function for every organization, so keep that in mind. However, if an organization has an internal audit function, then they will be responsible for monitoring the particular internal control systems operating effectiveness on a regular basis. And of course, wherever they identify a deficiency, they should rectify that deficiency by introducing a new control measure as well, isn't it? So that's basically some of the functions conducted by an internal audit function as well. Okay, folks, so all of these are people within the organization, isn't it? Internal auditors, are they external to the organization? They can be if we outsource the function. However, if not, then these are basically employees within the organization, isn't it? So keep this in mind. Okay, folks. So, and of course, it's the management's responsibility to oversee the functions conducted by internal auditors, isn't it? So keep this in mind as well. And finally, active oversight by those charged with governance is also another responsibility, isn't it? So by overseeing, by using those charged with governance, who are those charged with governance? First of all, these are basically the key executives of an organization, isn't it? So by having the key executives of the organization overseeing the financial reporting process as well as the internal control systems, etc., we can make sure that there is no fraud or error activities happening within the process, isn't it? So that's basically the idea mentioned here. Okay, folks, there should be an active oversight conducted by those charged with governance, which are basically the key executives such as CEOs, CFOs, board of directors, chairman, etc. Okay, folks, remember that. Now, moving on to the responsibilities of auditors. So what exactly are the auditors' responsibility in this situation? Let's take a look at that, shall we? However, auditors may detect fraud or error even though there is no responsibility to do so, because it may lead to a material misstatement in the financial statement. So remember, guys, who has the primary responsibility to prevent and detect fraud or error? The management, isn't it? And what exactly is the responsibility of the auditor then? If a particular fraud or error can lead to a material misstatement in the financial statements, then the auditor will have to take action against that. Okay, folks, so that's basically it. What action do they take? Well, basically they have to investigate into the fraudulent activity and report it to the management. Okay, folks, that's basically the thing. So keep this in mind. If there is a material misstatement in the financial statement caused due to fraud and error, then the auditor will have to investigate, identify it and investigate into it. Okay, folks, so remember that. Moving on, what are the responsibilities do they have? Let's take a look. At the planning stage, the auditor must consider the risk of material misstatement due to fraud and error when planning and performing their audit. So what's the idea here, guys? At the planning stage, what do? We have to make an expectation of that there could be a risk of material misstatement due to a fraud or error. Okay, folks, just to allot the sufficient amount of time. That's basically it. That's basically as to why we set such an expectation at the planning stage. Okay, folks, so keep this in mind. And secondly, the auditor should maintain professional skepticism throughout the audit, which is an obvious statement that we learned as well, isn't it? So remember that. Thirdly, they should obtain reasonable assurance that the financial statements are free from material misstatements that have been caused due to fraud or error. Okay, folks, that's yet again another relevant, I would say, responsibility, isn't it? Because we have to make sure that we have to provide a reasonable assurance. What is the ultimate objective of the auditor here? To provide to provide a reasonable assurance that the financial statement is not material misstated due to fraud or error activity, isn't it? So what we have to do here is basically simple. Okay, folks, we just have to provide a reasonable assurance that the financial statements are not necessarily misstated due to a fraud or error activity. Okay, folks, that's basically the thing. Moving on, if a material misstatement has occurred, the auditor is responsible for detecting the particular fraud or error. Okay, folks, if there is a material misstatement due to fraud or error in the financial statement, then we will have to identify and investigate into it, isn't it? As simple as that. And what if it's immaterial then? What if the error that we have identified or the fraudulent activity that we have identified has an immaterial impact? Then what should we do? Then what we are about to do is we have no responsibility of detecting that particular fraud or error. However, this should be reported to those charged with governance. Okay, folks, so that's basically the approach that we take here. Okay, folks, so if the particular impact of a particular fraudulent activity or an error is immaterial, then we have no responsibility to detect them. However, we can notify those charged with governance regarding that particular fraud or error activity, isn't it? So keep this in mind. Moving on, the inherent limitations of audit mean that the auditor cannot guarantee that the financial statements are free from a fraud or error, isn't it? So we know that we only provide a reasonable assurance. Do we provide any absolute assurance in audit? No, not really, isn't it? What is an absolute assurance? 100% guarantee that the financial statement is provided true and fair. Do we provide that? No, not really, isn't it? We only provide a reasonable assurance on the financial statement, isn't it? So remember that. Okay, folks. Now, one of the inherent limitation is that therefore we cannot guarantee that the financial statement is not materially misstated due to fraud or error activities, isn't it? As simple as that. Okay, folks, so keep this in mind. That's a really important point. Moving on to reporting responsibilities. So what's the idea here? We can report to the appropriate level of management if and only if they are not involved in the fraud, which is quite an obvious statement if you ask me, isn't it? Why? Because think about it, guys. If a particular management is involved in the fraud, is there any point in reporting it to them? No, not really, isn't it? They won't take any action against it, isn't it? So that's basically the thing. Okay, folks. So we will report the particular fraudulent activity to the management if there is no, if the particular management is not involved in the issue. Okay, folks. So keep this in mind. Now, another aspect that you have to remember is basically this. If the organization or if the audit client has an audit committee within them, what we can do is we can also report the particular issue to the audit committee first of all. Okay, folks. So the first preference here should be given to the audit committee and then to the management. Okay, folks. So remember that. Why? Because the audit committee acts as an independent platform between the board of directors as well as the management, isn't it? That's basically why. Okay, folks. So remember that. Now, if the audit committee is not necessarily taking any actions, then report directly to the management. And then what you can do is if the management is involved in the fraud, then you can report to those charged with governance. Okay, folks, then you can report to those charged with governance, which are basically the key executives at the top tier management level, isn't it? Now, what if they're also involved in the fraudulent activity? If they are also involved in the fraudulent activities, what we have to do is, we will have to, if they are also involved in the fraud, then the auditor will report to the regulatory or enforcement authorities after seeking legal advice. So why exactly are we seeking legal advice here? Because effectively, when you're communicating the particular confidential information of the audit client to an external party, that is the regulatory authority or the enforcement authority, you are effectively breaching the confidentiality agreement, isn't it? So that's basically why we have to seek legal advice before contacting these people. Okay, folks, so keep this in mind. So that's basically the idea here. So what is the level in which we report? First of all, we have to report to the audit committee. And then after that, we report to the management if the audit committee is not taking any action. If the management is involved in the fraudulent activity, then we report directly to those charged with governance. And if they are involved in a fraudulent activity as well, we will communicate the aspect to the regulatory authority as well as the enforcement authorities. Now, there is, of course, a really important person that you have to report to as well. Who is that? Basically, the shareholders of the organization, isn't it? And how exactly will we report this aspect to those to the shareholders? Basically, what we have to do is we just have to write it in the report. That's basically it. Just include a paragraph in the report stating that there was a fraudulent activity occurred within the organization, or there is an error that has been occurred, and yeah, all the people were involved in it. Okay, folks, something like that. And of course, another aspect that you have to keep in mind is that whenever there is a material misstatement caused due to fraudulent activities, then definitely the opinion that you would provide will be a modified or qualified opinion, isn't it? Why? Because there is a material misstatement and it's material. Okay, folks, that's basically why. And of course, yeah, that's basically what you do in your audit report. Let's continue reading. If a misstatement is discovered, the audit impact needs to be considered. Okay. And what else? This is done by looking at the nature and circumstance of the offense, and secondly, gathering information about the effect of the offense in the financial statements. If material, then we need to carry out more procedures on the area. So what's the idea here, guys? So these are some of the aspects that we need to consider regarding the audit impact due to a presence of a fraud or error. Okay, folks, so due to a presence of a fraud or error, what exactly would the audit impact be? How can we, or what all factors should we consider, to assess it? Okay, folks, that's basically as to what we are looking at here, isn't it? So, first of all, what we can do is we can take a look at the nature and circumstance of the offense. Okay, folks, is it a serious offense? What exactly would its impact be? That's it. And secondly, the effect of the offense in the financial statement. Does it create an overstatement of anything or understatement of anything? We need to look at that. Thirdly, if it is a material thing or if it is a material offense, then what we have to do is we need to carry out more procedures, isn't it? More procedures on this particular area, as simple as that. And the next aspect is basically this. Then the offense should be communicated to those charged with governance, as simple as that. Okay, folks, so that's basically it. If, of course, they are not involved within the fraudulent activity. And of course, yeah, ensure that they have an intention to rectify the error. If not, report the regulatory authority or enforcement authorities after seeking legal advice. So if the particular those charged with governance does not take action to rectify the error, then that effectively means that they're conducting a fraudulent activity, isn't it? So that's basically it. If they might just be involved in that particular fraudulent activity. If that is the case, we report to the enforcement or regulatory authority after seeking legal advice. That's a really important point, okay, folks, because we need to make sure that there is no legal consequence as a result of breaching confidentiality agreements. Okay, folks, so remember that. Moving on, fraud and error must be reported to management and the audit committee as soon as possible. Okay, why exactly is that? Well, it can be reported to the shareholders if the management as well as those charged with governance is involved with the fraud. And this is done by modifying the audit opinion and by including a paragraph in the audit report, isn't it? As simple as that. Okay, folks, so we first of all report the aspect to the audit committee or the management if they are involved in it, or if they are not taking any actions, then we communicate to those charged with governance. If they are involved in the fraud, we report it to the external authorities, that is the regulatory as well as the enforcement authorities. If And after that, we should also report this aspect to the shareholders as well. And how do we do that? By modifying the opinion within the auditor's report, and of course by including a paragraph within the auditor's report as well. Okay, folks, so that's basically how we communicate to those charged to the shareholders of the organization. Okay, folks, so remember that. So that's basically as to how we report ISA or fraud or error activities. Okay, folks, so keep this in mind. So now that's all for this particular topic. So effectively an easy set of topics, isn't it? As simple as that. Moving on to the next one, that is professional liability for auditors. So folks, when we talk about professional liability, we need to think of two situations. Okay, folks? So there could be professional liabilities towards the client as well as to third parties as well. Okay, folks, so keep this in mind. This is a really important point. The auditors can have a professional liability or an obligation towards both the client as well as third parties. And what exactly is the situation? Why exactly does that particular liability arise? Let's talk about that, shall we? So, first of all, when does a professional liability arise towards the client? Let's talk about that. Now, I want you to consider the audit process here. What exactly are we doing in an audit? We have two parties here, that is basically the audit firm as well as the audit client, isn't it? And then we know that the audit firm must provide an opinion on the financial statements on the audit client. That's basically the thing, isn't it? However, that's not the only responsibility, isn't it? There are some terms and conditions with this particular audit engagement, isn't it? And these terms and conditions are stated in a contract known as or an agreement known as the audit engagement letter, isn't it? So that's basically the main point of focus here, okay folks, the audit engagement letter. So we know that both these parties agree to this particular agreement, and we can definitely call it as a contract, isn't it? What is a contract exactly? A contract is basically an agreement between two or more parties, isn't it? In this situation, we have only two parties, that is the audit firm as well as the audit client, and they agree to some terms and conditions within the audit engagement letter to commence the audit practice. As simple as that. That's basically the situation here, isn't it? So, since we can call this particular document as a contract, let's consider a situation where the audit firm breaches some of the terms and conditions mentioned within the audit engagement letter. In such a situation, we can effectively say that the auditors are breaching contract law, isn't it? There is a breach of contract law. As simple as that. Okay, folks, so that's basically the first situation where there can be a professional liability towards the audit client. Okay, folks, when they breach the contract. And of course, we also know that the auditors have a duty to demonstrate due care and skill, isn't it? They have to demonstrate due care and skill. Where have we learned that before? We talked about professional competence and due care, isn't it? So what's the idea here? We have to stay updated on our knowledge, technical knowledge, and the knowledge regarding all the new professional standards, ethical standards, quality control standards, etc. And we have to provide high competence services to the particular audit client. We have such a duty, isn't it? So are we demonstrating that duty towards the audit client? Are we complying with all the professional standards or ethical standards as well as quality control standards? Are we providing high quality services to the audit client? Because if we are not, then effectively yet again we have a professional liability as well, isn't it? So those are the two situations where a professional liability can arise towards the audit client. Okay, folks, one, if we breach the audit engagement letter, which is basically a breach of contract law, isn't it? And secondly, if the auditors does not demonstrate due care and skill, then definitely the audit client can sue the particular auditors. So that's basically the idea here. Okay, folks. So that's basically the first situation where there can be a professional liability towards the audit client. Okay, folks. So remember that. So let's read about it, shall we? Liability to clients. the auditors have a contract with their client, and a professional liability arises when there is a breach of this contract law. That's basically it. Okay, folks. What else? The auditor therefore has a duty to demonstrate due care and skill. If they do not demonstrate due care and skill and may provide low quality services to the audit client, then definitely the audit client might sue the audit firm, isn't it? So that's basically the idea here, and that is where the professional liability arises. Okay, folks. So that's basically the idea. Moving on. In order for them to demonstrate this without any negligence, they must follow the professional, ethical, as well as quality control standards. So that's basically the best way that we can take as a precaution against such professional liabilities, isn't it? We should always comply with all the professional standards, all the audit standards, accounting standards, as well as the ethical standards, as well as the quality control standards as well, just to make sure that we are providing high competence service to the particular audit client that we are trying to audit. Okay, folks, that's basically it. And they must also comply with the terms and conditions stated within the audit engagement letter. As simple as that. Okay, folks, just to avoid any sort of breach in contract law. That's basically it. Okay, folks. So that's another situation where a liability towards client can arise. Okay, folks. So keep this in mind. Just a simple set of topics, isn't it? That's basically it. Now, moving on to the next situation. Now, when does liability towards the third parties arise? Let's take a look at that, shall we? So before deep diving into this material, I want you to consider an example situation. So let's say that I am recommending to you, the student, a restaurant. Okay, folks, a restaurant or a shopping mall, it can be anything. Okay, folks, so I am recommending this particular restaurant to you. So let's say that you have went to that particular restaurant to have food, have lunch or dinner or anything. And of course, you did not like the food. Okay, let's consider a situation where you did not like the particular food as well as the services provided by the restaurant. In such a case, who would you make liable for your bad experience? You would of course make the restaurant liable for the bad experience that you faced, and at the same time, you would also make the person who have recommended this particular restaurant to you liable as well, isn't it? So that's basically the idea behind professional liabilities towards third parties as well. Okay, folks. So in my place, I want you to consider the audit firm, and in place of the restaurant, the audit client. Okay, folks. And in your place, you have the third party. And the third party can be anyone. Okay, folks. It could be a bank or financial institutions, a supplier, a customer, etc. Okay, folks. So keep this in mind. And let's consider the situation as that of a bank. Okay, folks, the third party is a bank here. And I want you to consider the situation as when the audit client wants to apply for a loan and the audit firm is representing the audit client in such a situation. Is that ethical, first of all? No, not really, isn't it? Why? Because there is an advocacy thread there, isn't it? We must not represent the audit client in front of anyone, isn't it? So that's basically any third party. So that's basically the ethical threat here. So keep this in mind. However, let's assume that there has occurred such a situation. Now, in such a situation, what are we doing here? The audit firm is basically representing the audit client in front of the bank or financial institutions, and after that the credibility of the audit client will definitely increase, isn't it? So after an increase in credibility, the bank would obviously provide the bank loan to the particular audit client, isn't it? So the bank loan has been provided. However, after a few months, let's say that the audit client is not providing or is not paying the interest correctly, or they're not paying any of the bank loan amount. Okay, folks, in such a situation, what can happen? Definitely the bank would try to sue the audit client. That's the first thing. And secondly, they would also sue the audit firm for their financial losses, isn't it? Because the bank has relied on the recommendations provided by the audit firm. However, that recommendation was false, and therefore now the audit firm is more liable to recompensate the bank with the amount that they lost, isn't it? So if there is a financial loss incurred by the third party as a result of relying on the audit firm's recommendations, then there would be a professional liabilities for the auditors to the particular third party. Okay, folks, so that's basically the situation where a professional liabilities to third party can arise. So keep this in mind. So Quite an interesting situation, isn't it? So keep this in mind. And of course, remember guys, whenever you write an advocacy threat, or whenever an advocacy threat is indicated within the scenario, then you can also write a professional issue of professional liability as well. Okay, folks? So keep this in mind. So as I stated earlier, in your exam, you can be asked for ethical issues, or you can be tested on ethical issues, as well as professional issues as well, isn't it? So, it could be the same situation, okay folks, it could be a situation where the audit firm has represented the client in front of a bank, okay folks, or the audit client has invited the audit firm to represent themselves or to represent them in front of a bank meeting, okay folks, that's basically a possible situation. Now, in such a situation, there is both an ethical issue as well as a professional issue arising here, okay folks. So what exactly is the ethical issue? The ethical issue is that there is a advocacy threat, isn't it? There is an advocacy threat of representing the audit client in front of a third party, and the professional issue here is that of professional liability. Okay, folks, there is a possibility that a professional liability can arise for the auditors if they represent the client in front of the third party, isn't it? So that's basically it, okay folks. So it could be the same situation, but we can state 2 points, isn't it? We can also state a ethical issue as well as a professional issue if the examiner requires you to write both these situations, okay folks. So remember that. 2 birds with 1 stone, isn't it? That's basically the idea here. We will of course be practicing a lot of questions in the question marathon in relation to this, so that you can get a better understanding as to how to tackle these questions as well. Moving on to the liability to third party as well. So what exactly is the liability to third party? Let's take a look. A third party can sue the auditors if the auditors have breached the law of tort. Okay, so what exactly is the law of tort means exactly? Let's take a look. The law of tort actually means you have to look at 3 things. Okay, so what exactly are the 3 things? First of all, the auditors must demonstrate a duty of care. We will look into as to what a duty of care means a bit shortly. However, let's move on to the second one. Has the auditors breached any standards? Okay, folks, so if the auditors have breached any sort of audit standards, then we can say that then the third party can sue the auditors. Why? Because the third party is relying. Okay, folks, third party can be anyone, isn't it? It can be the intended users of financial statement as well, isn't it? So if the audit firm does not comply with all the professional standards appropriately, then obviously they may conduct a low quality audit, isn't it? So if they conduct a low quality audit, that effectively means that there's an increased level of audit risk. So what is an audit risk? The risk that they may provide an inappropriate audit opinion, isn't it? So providing an inappropriate audit opinion, is there any negative effect to it? Yes, there definitely is, isn't it? Because the intended user would blindly believe on the inappropriate opinion and make decisions on the audit client accordingly, isn't it? So that's basically the issue there. So if as a result of that, the third party if they have incurred any sort of financial loss as a result, then who would they sue? Would they sue the client? Well, rather they would be much comfortable with suing the audit firm, since they provided the opinion and the the intended users have relied on that particular opinion, isn't it? So that's basically the idea here, okay folks, so keep this in mind. So if the auditor has breached any standards, then that is yet again another breach of the law of tort, okay folks, so remember that. Moving on to the third one, that is kind of obvious. Has the third party incurred any financial loss as a result on relying on the auditors? So that's basically yet again another kind of an obvious situation, isn't it? If the third party has incurred some sort of a financial loss by relying on the auditor's opinion, then definitely the third party can sue the set of auditors. Okay folks, so keep this in mind. So that's basically as to when the liability towards third party can arise. Now let's deep dive into the concept of duty of care now, shall we? So what does duty of care means exactly? Let's take a look. A duty of care exists when there is a special relationship between the parties. Okay, so what exactly is this special relationship? So, If let's say that a third party wants to prove that the particular auditor has breached the duty of care, what all things must the third party prove? Exactly. Let's take a look at that, shall we? So they must prove three basic things. The first thing is basically this: whether auditor knew or should have known that the third party would rely on the financial statement. So that is the first thing that the particular third party must prove, isn't it? So what do they have to prove? They have to prove as to whether the auditor knew or should have known that the particular third party would rely on their opinion or not, isn't it? So that's basically the first thing that they should prove. Secondly, they have to prove whether the third party has sufficient proximity. So what does proximity mean? Well, this basically means that the third party has the sufficient level of close relationship with the audit client. Okay, folks, that's basically another thing that the third party must prove. And thirdly, whether they would have acted differently if the financial statement showed a different picture. Okay, folks, if these three conditions are satisfied, then the third party can prove that the auditors have breached the duty of care. Okay, folks, that's basically the thing. First of all, they must ensure as to whether the auditor knew or should have known that the particular third party would rely on their opinion. Secondly, they should prove as to whether the third party has a sufficient level of proximity with the audit client. And thirdly, they must also prove that their decision would have been different had the particular opinion been different. Okay, folks, so that's basically it. If the audit report had shown a different picture, or if the financial statement has shown a different picture, then would the particular third party make a different decision, or would they just make the same decision? If they make the same decision, then they cannot necessarily sue the auditors, isn't it? However, if their decision was influenced by the recommendations or opinion provided by the auditor, then definitely what can happen? Then the third party can sue the auditors, isn't it? So that's basically the situation here. Okay, folks, so keep this in mind. And that is basically what duty of care is all about. Three basic things, isn't it? As simple as that. Moving on to the next one. So how exactly can we reduce the risk of becoming liable? Because this is a risk, isn't it? Because there could always be a possibility that a particular third party may sue the auditors for inappropriate opinion, or any other professional liabilities can arise, isn't it? So in such a situation, what all things can we do, to either prevent or reduce the risk of this particular risk occurring? That's basically as to what we have to learn now. Okay, folks, there's an easy way to learn that. All you have to remember is CARQUIL. Okay, folks, what is CARQUIL all about? C stands for client screening. Okay, folks, what is client screening all about? Well, basically the first step before accepting the audit client, isn't it? So that's basically it. Folks, if you conduct the client screening process appropriately, then to a certain extent you would be able to, demonstrate duty of care as well as provide high quality services to the audit client without breaching any contractual law or anything. Okay, folks, that's basically the first thing. So in client screening, we look at things like as to whether we have the sufficient level of resources to conduct the audit or not. We look at the management's integrity, we look at independence and objectivity and all ethical matters, etc., isn't it? So keep this in mind. All these things should be considered when conducting the client screening process itself, just to make sure that there is no risk of professional liability as well. Okay, folks, so keep this in mind. Secondly, what we can do is we can adhere to the terms of the engagement letter, isn't it? Why? To avoid any sort of breach in contract law, isn't it? So that's basically the second situation or second method in which we can reduce or avoid the risk of becoming liable towards the client or the third party. Then we have R, which stands for restricting the use of reports for their intended purposes. What's the idea here? Well, what we can do is we can provide certain clause or other statements suggesting that the use of that particular report should be restricted to internal purposes only or something like that. For example, let's take the management letter. Okay, folks, the management letter should not be published to the public, isn't it? The management letter is issued by the audit firm to the audit client just for internal purposes alone, isn't it? So that's basically it, okay folks. So if the management letter, why exactly is that done? That's basically because we are not conducting an in-depth analysis of the system's internal controls or anything, isn't it? Which is exactly why there is a certain risk element to the management letter, okay folks. It does not cover every deficiencies or every problems within the organization, which is exactly why it is specifically mentioned that the management letter should be used for internal purposes alone, isn't it? So what if the management has published this particular letter to the public? Then that would mean that the particular organization has a few inefficiencies. However, they have rectified them, isn't it? So the people, that is the public, will blindly believe on the auditor's recommendations, isn't it? Which is exactly why for some reports what we do is we restrict their use. Okay folks, some reports use is basically restricted by adding certain clauses to it, such as used for internal purposes only or something like that. Okay folks, that's basically the idea here. Fourthly, I would say we have to comply with all the quality control procedures. Why? So that we can provide high quality services to the audit client, so that we can demonstrate duty of care as well, isn't it? So that's basically the fourth aspect to it. And what Q stands for? I stands for insurance. Okay, so there is a insurance known as the professional indemnity insurance. Now this particular insurance provides coverage for any sort of professional liability arising for an audit firm. Okay folks, that's basically the idea here. And then we have L, which stands for limited liability partnership. Okay folks, so your audit firm can be a limited liability partnership. Why exactly is that? This is so that the partners does not have unlimited liability. Okay folks, that's basically it. We're limiting the liability of the partners of an audit firm. Okay folks, that's basically another arrangement that we can introduce in order to reduce the risk of professional liability, isn't it? So keep this in mind, because even if an organization or an audit client or a third party has sued the organization, the audit firm, then definitely the liability will only be limited to the assets of that particular partnership and not the partner's personal finances or assets, isn't it? So that's basically the idea here. Moving on, finally we have liability cap with the clients. So what is liability cap all about? Well, what we're gonna do is we're gonna limit the level of liability by adding some clauses into the particular audit engagement letter. Okay, so that's basically the idea here. We limit the liability by adding some clauses in relation to the amount of liability that the audit firm would be liable to. That's basically the idea behind liability cap with clients. That's basically it. Okay, just adding some clause into the agreement, as simple as that. So these are some of the methods in which we can reduce the risk of becoming liable, isn't it? So remember that these are really important. We can provide recommendations and some of the answers as well. Okay folks, so keep this in mind. So that's basically as to what CARQUIL is. Okay folks, so C stands for client screening, A is for adhering to the terms of engagement letter, R stands for restricting the use of report, Q stands for quality control, I is for insurance, L is for limited liability partnership, and the final L is for limited cap with clients, isn't it? As simple as that. Okay folks, so that's basically how you reduce the risk of becoming liable to both third parties as well as to the client as well. Okay folks, so remember that. Moving on, so that's all for the professional liabilities of auditors. Now let's take a look at another really interesting and a small topic, that is expectations gap, shall we? So what exactly is an expectation gap all about? Well, let me just demonstrate that concept to you a bit through a simple illustration, shall we? So first of all, what you have to understand is that the general public as well as the management will have an expectation of the auditor's job. Okay folks, so this bar basically indicates the auditor's job level, and this is the management's expectation. Let's say that it's the management, or it can also be the intended user's expectation regarding the auditor's job. Okay folks, however, the reality might be a bit different, isn't it? So the auditor's job in reality might only be a bit less than their expectation. Okay folks, so you see this gap over here. Let me just draw it out for you. So there is a gap in between, isn't it? So this particular gap is known as the expectations gap. Okay folks, so what does this mean? Basically it's the difference or the gap in between the expectation of the intended users as well as the management regarding the auditor's job and as to what the reality of the job is all about. Okay, folks, that's basically as to what expectation gap is all about. Okay, folks, just the difference between expectation and reality, as simple as that. So, let's read about it. So, this is the gap between what the public believes the auditor can do and what the auditors actually do. Okay, folks, it's basically the difference between the expectations of the general public as well as the actual reality of as to what the auditor does. Okay, folks, so we have to effectively avoid or reduce this particular expectation gap, isn't it? So how exactly can we do that? Well, that's a really important concept to know. Okay, folks, so what exactly or how exactly can we reduce the expectation gap? Well, some of the points are kind of obvious, isn't it? We can just mention the responsibilities of both the management as well as the auditors within the audit engagement letter as well as the audit report. That's basically one, isn't it? What else? Let's take a look. Responsibilities of management and auditors in the audit report. So we can mention those responsibilities to avoid any sort of misunderstanding between responsibilities with both the, just to make sure that the general public is aware as to what the auditors can actually do. And what else? The responsibilities of management and auditors in the engagement letters should also be mentioned, just to avoid any sort of misunderstanding between the responsibilities between the management of the audit client as well as the auditors. Okay, folks, so remember that. What else? We should educate the intended users that we can only provide reasonable rather than absolute assurance. So, the general public or the intended users might just think that the auditors provide a 100% guarantee that the financial statement provides a true and fair view, isn't it? However, is that the reality? No, not really, isn't it? The auditors can only provide a reasonable assurance, which is less than 100%, isn't it? So that's basically the thing. Okay, folks, there is always an inherent risk there, and this particular aspect should be educated to the intended users. Okay, folks, that's basically another method through which we can reduce the expectation gap. What else? We can also use disclaimers to reduce the amount of reliance users can place on reports. So that's basically yet again another thing that we can do, isn't it? What can we do here? We can reduce the amount of reliance on the audit report or any other reports that the auditors provide by providing a disclaimer to it. Okay, because what is a disclaimer? Basically a notification stating that the particular report has some risks related to it as well as the particular report is of a particular limited use. Okay, folks, you can't just blindly believe as to what everything, or you can, I wouldn't say not blindly believe, I would say you cannot completely rely on the report and then take a decision. Okay, folks, that's basically the disclaimer that we provide, as simple as that, which is, notifying the particular user of that particular report as to what are the limitations of the report as well as what exactly should be expected from the report as well. Okay, folks, so that's basically the idea here. So those were some basic measures through which we can reduce the expectations gap, isn't it? So that's all for this particular topic. And that's all for this particular session as well. Okay, folks, so I will see you later in the next few sessions where we will practice more questions as well as learn more interesting concepts as well. Okay, folks, so until then, this is Vishnu Vijay signing off.